But the 2% inflation target is still there. So how come they can still cut the target rate?
Yeah, I mean, so since 2020, and they have already shifted under Powell, and they have changed the regime already. I mean, 2% is not a hard target.
Hi, everyone. Welcome to The Curious Investors, the show where we break down complex financial topics and to help you make more investment decisions. So Saxo recently released its Q4 quarterly outlook for 2023. And our colleagues, Charu and Fiona, has discussed about the strength of the USD and also its implications. So today I'm here with Redmond, our strategist, and we will be discussing about opportunities in other kind of assets.
Yeah, thank you for having me again to the Curious Investor.
So Redmond, can you tell us some of the key ideas of the Q4 outlook?
I think the core ideas in the Q4 outlook is really the interest rate in the US is too high. Actually, globally, it's quite high in the major developed country. And that start to hurt the business and also start hurting the household. And also for some of the household, and actually they have already depleted much of the saving from the government handout throughout the pandemic. So the high interest rate now, I mean, they have been quite resilient so far, but it's going to hurt. And also students, I mean, the student don't have to start being repaid again, and some other headwind as well. And the dollar is very strong, and it's very strong dollar is also a drain on liquidity globally. So we are expecting the economies to slow down in the major economies, and inflation a bit sticky. So we are expecting what we call a stagflation-like kind of environment going forward.
So can you elaborate on the stagflation-like, and what does that mean to our investors?
Yeah, I mean, stagflation-like, as I said, basically is a combination of, stagflation itself is a kind of slowdown, recession, and in combination of a high inflation. But we are not talking about like in the 1970s or early 80s, and when the recession is quite severe, and also the inflation. Actually, for example, in 1975 hit 12%, and then in the 1980s it was 15%. But we are not talking about inflation going back to those levels. But what we were saying that the economy will slow down and in the fourth quarter and probably throughout the first quarter next year. And inflation rate probably will stay around 3% to 4%. It's not returning to the 2% target of the Federal Reserve, but it is not bouncing back to the very high level as well. So in this kind of environment, and we call it kind of light version of stagflation. So that's why we coin the term stagflation light. And in terms of implications, is that actually we think that is present a good environment for bond investment in bonds, especially in the short end. The short end, we are talking about from 2 years all the way to 5 years in high quality bond, like in US Treasuries. And in the equity side, we will be moving toward, I mean, we are not, we think that we should stay invested. Investors should stay invested in equities, but probably we should be taking some profit and in the technology sectors and actually move to a more defensive sectors like energy, consumer staple, and healthcare, and so on.
So you mentioned that 2 to 5 years bonds, right? But I know that the 3 to 6 months, the T-bills are looking quite good. It's for 5.4 to 5.5%.
Yes.
Yeah. So isn't that better off for our investors?
I mean, yes. I mean, but you have to consider that if the Fed will start cutting rates, few months later, actually, we are expecting that they will start doing that in the first half of next year, and then when you roll over your 3-month, 6-month T-bills, you are not going to get that 5.4, 5.5%. And if you buy into a 2-year and up to 5 years, usually these kind of bonds are quite set. The price is quite sensitive to interest rate cut. When interest rate cut, you first of all, you still have the coupon, high coupon, and you secure the yield. At the same time, if the Fed cut interest rates, the yield will enjoy also some capital appreciation. The bond price will interest rate coming down, and then the bond price will go up because it's other investors will look at the bond say, wait a minute, I mean, you have a very good coupon. I mean, so I should, that worth more. So the price will go up when interest rate come down. So that's why we think that this 2 to 5 years is treasuries is actually a better alternative to cash at the moment.
Redmond, you mentioned that they will be cutting rates. So can I ask why?
Yeah, I mean, first of all, we talk about that the economy will be slowing down. Maybe there's a mild recession. But yes, and so that is not the only reason. There's some other reason, for example, and the Fed, even though a lot of time we talk about the Fed have two mandates, so stable prices and also full employment and so on. This the dual mandate, but in fact, according to 1913, the Federal Reserve Act, and based on that, the Fed was created. And they have actually a third mandate that's to maintain, to ensure there's a moderate long-term interest rate, even though they don't talk about that so much. The media don't talk about it that much also. And so the treasury market is very important in the Fed, for the Fed. And they need to maintain the functioning of the treasury market and also maintain long-term interest rates while they're moderate so that the US government can finance the deficit, can pay off the debt. And so if you recall, back in 2020, March, I mean, when the pandemic first hit, and that's a big turmoil in this treasury market. I mean, it's been very volatile, and suddenly there were no bid, and bid and offer spread very wide. And so, I mean, for holding treasury, it's a safe haven asset. You need for liquidity, so that it's when you need cash, you need to sell it. So the Fed stepped in. In over 3 weeks' time, the Fed actually bought about $1 trillion worth of US Treasury. That's a lot of money. So, and then fast forward to 2022, October, and this time in the UK. I mean, when the UK market also suddenly, the gilts market suddenly become very illiquid, no bid, and yield jump. And so the Bank of England have to jump in, have to intervene, and to buy UK gilt to stabilize the market. So that's why back in August this year in Jackson Hole, there's one paper also presented to talk about this concern, a lot of concern about whether there will be some problem with the functioning of the US Treasury market, especially when the market is so big now, but the daily turnover is not relative to the overall outstanding size of treasuries is relatively small now. And then at the same time, the primary dealer, those dealers who actually are obligated to bid in the auction, they are the market maker, in the interbank market, and their capital base have not grown in the same proportion to the outstanding amount of treasury. So they don't have the capacity to provide liquidity when there's a lot of seller coming to the market. So they have some plan to how to improve it, so on, but we don't have time to cover those here. But the key message I'm saying that is that the Fed want to make sure that the treasury market will function, and also they want to make sure that the government can finance the deficit. And to finance the deficit, to keep the long-term interest rate moderate, you need to keep it below the nominal growth of the economy, i.e. the real growth rate plus the inflation rate. Because if your interest rate is much higher than your nominal growth rate, you just cannot pay down your debt because the interest payment is already faster than your growth. So there's also another additional consideration for the Fed to say they probably don't want to see interest rate going higher from here. And so when the economy is slow, despite all the rhetoric, because the higher for longer, whatever, but when the economy is slowing, and they have actually a lot of incentive to keep the interest rate down and even cutting. And that one additional one that's more about the Fed itself. The Fed actually, if the Fed is a commercial bank, it's already bankrupt, it's insolvent, because the Fed has only a capital of about 42.4 billion. And it has a $1 trillion $1.1 trillion of mark-to-market loss back in June. At that time, interest rate is lower than now. And so the mark-to-market loss actually now much bigger. And every year now, they are paying about $250 billion of interest. They are paying interest. Actually, the Fed is now the borrower, the last resort, because if they pay interest on the bank reserve, those banks put deposit at the Fed, and the Fed pay them interest of 5.4%. And then is the money market fund, when they do a reverse repo, put money into the Fed pay them 5.3%. So that is talking about 3.1 trillion of those kind of reserve and the 1.4 trillion of the reverse repo. So based on this amount, you get about 250 billion kind of interest rate cost. So, I mean, it's an election year next year. I mean, if the Congress pick that up and say, you are losing so much money, yeah, and then it's, that's a political issue. I mean, there's some dilemma we don't have time to cover here, but there's another reason that is, that would be difficult for the Fed to allow interest rate to move further higher from here. So all this together, we think that is, despite what the rhetoric they are now talking about, and we think that is they are going to cut rate actually in the first half.
But the 2% inflation target is still there. So how come they can still cut the target rate?
Yeah, I mean, so since 2020, and they have already shifted under Powell, and they have changed the regime already. I mean, 2% is not a hard target. If they change to what they call the flexible average interest rate target, something like that. The idea is that 2% is something average. It's sometimes they undershoot, so that for some years, like in the past, and the futures, they will say they will allow it to overshoot for some years. So that on average is about 2%. So it's never it's not a target. It's not even a cap. Definitely not a cap. If you talk about inflation fighting, the mandate is actually stable price. If you really ask me, even 2% is not a stable price, but basically they are taking 2% out of my pocket every year. But for the Fed, I think they have other objective, right? So I think we think that basically that as long as they can use that as a kind of reasoning to say that as long as on average over some years, they never define how many years, it's around 2%, they're okay. So they will, based on what we discussed earlier, for those reasons, they will shift the rhetoric and then will start cutting rates, despite the inflation rate still around 3% or 4%.
So recently there is a bond sell-off. So do you still think that it's a good time to buy bonds?
I think, that's why we emphasize that we want to buy basically 2 years to 5 years. That is most sensitive to interest rate cut. And we have to decompose why the bond market sold off, okay? Bond yield, long-term bond yield have two components. One is the expected path of the future short-term interest rate, okay? The short-term interest rate in the future, how they compound. So there's an expectation of the future's interest rate, the short-term interest rate over the last, for example, if for 10-year Treasury notes, that would be it should be the compounding the expected short-term interest rate over this 10-year time. Another component of it is what we call the term premium. So this is what the investor demand on top or below this compound short-term interest rate. So that means it's the factor in addition to your expectation of short-term interest rate. So so one thing affecting the long-term bond yield is the short-term interest rate over the life of the bond, let's say 10 years. So that is depending on the Fed policy. And then the second one is basically it's kind of insurance premium, to say if we are not so sure about the path of the rate, not so sure about inflation, not so sure about the liquidity of the market, and many other reasons, it's kind of a risk premium for the uncertainty to compensate for the investor to hold the bond for 10 years. So so what the Fed do will affect the first part, right, and the expectation, and then the other factor will affect the second part. But if you look at but this is estimate. So the New York Fed has done a very good job. I mean, if you go to their website, you can see they have done some econometric model. They do the estimation. And then if you look back, the sell-off, actually the last one, this most recent one, started in July this year. And since July, and the 10-year yield moved up about 97 basis points, I mean, let's say 100 basis points. And then the term premium, according to the estimation by the New York Fed, actually is more 117 basis points, more than 100 basis points. So the rise in the 10-year yield actually is completely due to the increase in the term premium. It's not really like what you read in the newspaper. That is because it's investors adjusting the expectation for Fed policy over the next 1 or 2 years, and or what they call the higher for longer. It's not really that. It's really now the investors think that is volatility higher, uncertainty higher, so demanding some risk premium or insurance for holding to the bond for a long time. So all I said here is say that is that the Fed is cutting rates, so those shorter term bonds, they don't. I mean, they are more sensitive and most influenced by the futures, Federal Reserve interest rate policy. The yield tend to come down, and then in those for the longer end, the premium, the term premium will increase, so that the curve will be steepened. So relatively, the yield will for the longer end will come down slower when the Fed cut rate. So it's better to hold the shorter one, but not. I mean, the sell-off is not because of now the market expecting the Fed will really raise rate for a long time and so on. So as long as stated in the shorter end, I think that is quite a reasonable kind of investment opportunities. For the longer end, we say that there may be some risk there from what I say is from 10 years to 30 years, and then we have to that part we have to be a little bit patient, but we stay a little bit shorter and should be quite fine.
So how do you think we can benefit from this deflation light, other than the bonds that you mentioned before?
Yeah, I mean, say in addition to buying 2 to 5 year Treasury high quality or how the high quality corporate bond, for for traders, for the audience who's actually like is quite experienced in trading futures, and they can do a steepening trade and yield curve steepening trade. What that means is they can buy the 2-year Treasury notes, and then is again selling the 10-year Treasury notes, and so that when the yield in the short term, the 2-year came down faster than the 10-year, as the scenario we discussed earlier, then the trade will make money. But of course, futures trading is not for everyone. It's really for those who are experienced in that, and also this is only we are sharing some ideas. We are not recommending our audience to actually do a trade. Yeah, I mean, that's all based on your own experience, investment experience. And other than that, I think we talked about stock earlier, right? Yeah. Okay, maybe I can add a little bit. Is as we said, I mean, we are not asking investors to say to reduce, or sell all the stock holding. I think they should stay invested, because it's really a light version of this stagflation. At the same time, the Fed is cutting rate. Mm-hmm. So we are expecting some headwind in the stock market in the near term, but we are not calling for a big, it's a very big retreat in the stock market. And so there's still some opportunities there. But the technology stocks may be a little bit expensive, and then the commercialization of, I mean, in the longer term, we're still quite optimistic about technology, including AI and so on. But it takes a long time for many of those technology to be commercialized and then to generate the revenue. And so we tend to think that maybe it's the time that it can take some profit and move to more defensive sector, because it's based on historical pattern or analyzing the historical data. I mean, the more defensive sectors is actually will outperform in this kind of environment. And then when things turning up again, of course, at that time can move into technology again. So I think that pretty much summarizes the key point of our quarterly outlook. Maybe the one last point I can add is that we still quite structurally like commodities. So so gold or copper and those is we are still an energy, and we still like it. Yeah.
Thank you, Redmond, for today's quarterly outlook. And stay tuned for more videos that's about the financial markets and more discussions that are in depth and may give you some ideas on investments.
Thank you.